Welcome back to the Explainer. Man, I am absolutely thrilled you're tuning in today because we've got an incredibly fascinating earnings report to unpack. We're looking at the Q2 2026 financial results for STMicroelectronics. And look, this isn't just some boring spreadsheet of numbers, right? This is a real-time look at the actual physical engines running our modern world. Everything from electric vehicles to AI and even the literal new space race. Our goal today is to tear into this massive report and figure out exactly what is powering this company's unstoppable momentum. I want to hit you right out of the gate with the sheer scale of what we're talking about here. $3.49 billion. That is the net revenue ST generated in just the second quarter of 2026 alone. I mean, when you see a massive number like that, you really have to ask yourself, how is this company generating so much money right now? What physical technologies are literally flying off the shelves to drive a top line of nearly $3.5 billion in just 3 months? Okay, let's dive into this. Here's how we're going to break it down today. First, the Q2 revenue surge. Then, AI and the space race. Third, we'll look at what's driving industrial and auto. Fourth, margins, cash, and capital. And finally, accelerating into the future. All right, section 1, the Q2 revenue surge. So STMicroelectronics has firmly established itself as a true financial powerhouse in the current semiconductor landscape. And honestly, they're just completely outperforming market expectations right now. The big headline figure here? A massive 26% year-over-year revenue growth. But, it's not just the yearly comparison that's wild. They also posted a 12.7% sequential increase right from the first quarter. And that sequential jump is absolutely crucial because it pushed them 110 basis points above the midpoint of their own business outlook. So they didn't just meet their targets, they confidently cleared them. And this brilliantly illustrates exactly what that growth actually looks like. So check this out. Q2 2025 sat at $2.766 billion. Fast forward exactly 1 year, and that bar is a towering visual reality at $3.487 billion. When a company with a multi-billion-dollar baseline manages to just add over $700 million to its quarterly revenue in a mere 12 months, yeah, you know for sure there is a massive shift happening in their end markets. Moving right along, Section 2, AI and the Space Race. Okay, so on the balance sheet, there's this segment called CCEP, which stands for Communications Equipment and Computer Peripherals. In Q2, this specific segment jumped an unbelievable 50% year over year. So the direct question we've got to ask is, what on earth is driving a 50% surge in a single division? Well, the answer is artificial intelligence data centers. And we aren't just talking about the software side. We're talking about the massive physical server infrastructure required to run modern AI. Demand here is so crazy strong that SCT has actually had to raise their revenue ambitions. They now expect their data center revenues to cross the $1 billion mark in 2026. And assuming the current dynamics keep up, they expect to hit well above $2 billion in 2027. That is just phenomenal, compounding growth, all anchored right in the AI boom. But wait, the surge isn't just happening on the ground, it's literally happening in space. The commercialization of low Earth orbit, or LEO satellites, is creating this massive new market for high-performance silicon. Get this, the addressable market for these satellites is projected to hit $3 billion by 2030. ST is aggressively targeting this space, aiming for well above $3 billion in cumulative revenue between 2026 and 2028 from the LEO satellite business alone. Up next, Section 3, Driving Industrial and Auto. Now, what's really interesting about this slide is how that $3.49 billion pie is actually sliced up. Despite that crazy 50% surge we just talked about, CCEP still only accounts for 13% of total revenue. Industrials matches it at exactly 13%. Personal electronics remains a pretty heavy hitter at 33%, but look at automotive, a massive 41% of ST's entire end market revenue. Automotive is, without a doubt, the core foundation of this company. Let's anchor those abstract percentages to the real physical world for a second. That 13% slice for industrial, that actually represents a 34% year-over-year growth, driven heavily by advanced robotics. We're talking end-to-end functional safety systems for industrial setups and even humanoid robots. And that massive 41% automotive slice, that grew 16% year-over-year, basically fueled by continuous design wins across hybrid and electric vehicles. The focusing on everything from onboard chargers to active suspension and safety applications. These are the traditional physical engines burning ST's silicon fuel. All right, Section 4, Margins, Cash, and Capital. To really ground this dense financial data, I want to read a quote directly from ST CEO Jean-Marc Chery. He noted, during the quarter, demand increased further. We saw improved visibility and signs of tight supply in several product categories. Inventory and distribution is now below our standard target. Objectively speaking, this is just a fascinating mechanical environment for a supplier to be in. They're experiencing such insanely high demand that supply is tightening and inventory is actually dropping below standard targets. It is very much a seller's market. And you know what? That tight supply translates beautifully into actual financial flexibility. Look at these highlights. Gross margin is sitting at a very healthy 34.8%, and that massive revenue is actually converting into real hard liquidity. They generated $502 million in net cash from operating activities and a positive free cash flow of $75 million for the quarter. Add all that up, and their net financial position is a rock-solid $2.01 billion. They are incredibly well capitalized to just keep funding this crazy growth.
Finally, Section 5, Accelerating into the Future.
Let's move to and see how this all builds into our final narrative, the forward-looking guidance. So the crucial point here is how they're viewing the second half of 2026. Normally, the semiconductor industry sees a pretty standard seasonality, where the second half of the year grows about 15% compared to the first half. But SD is projecting something way bigger. Driven by those AI data centers and LEO satellite programs we discussed earlier, they're expecting a massive acceleration in Q4, aiming for revenues above $4 billion. This means their second half growth is going to completely smash that normal 15% seasonal benchmark. Which leaves us with a truly provocative question as we wrap up this explainer. With the absolute explosion of physical infrastructure needed for AI data centers and the vast new frontier of low Earth orbit satellites, are we just seeing a temporary boom? Or will these two massive industries permanently redefine the historical seasonality and the ceiling of the entire semiconductor market? STMicroelectronics' Q2 report certainly suggests the rules of the game are changing for good. Thank you so much for joining me for this deep dive. Keep your eyes on the silicon, everyone. It's literally building our future.